So now, in the first class, we talked about um, introduction to market structure. We introduced liquidity, that is for inducement. We introduced one point of interest, that is the order block. And like I said, there are other points of interest that I make use of, which is like just one more. And I'm going to talk about it in this class. Now, there are rules that guide us using POIs, and there are also like knowing when to make use of this POI or this POI or this POI, because there are cases in the market where you have multiple points of interest, and your problem will not be the one to choose, the one to make use of, because it becomes a lot. And so sometimes you can have two other blocks. There sometimes you can have three breaker blocks. There sometimes you can have two other blocks, two breakers, anyone, and you don't know they want to make use of simply because you have more than one POI. And then also understanding the rules in picking a point of interest will also actually let you know where your stop loss is actually meant to be. Do you understand? Because now, if you're not sure of where market is going to react, or you don't have a clue of which POI market is going to respect, you're going to get confused with where to place your stop losses, because you wouldn't know where markets may react to. So you now become skeptical of where to place your stop losses. You now end up extending your stop loss where way past where it's supposed to be, and so on. So now the other point of interest that I make use of is what you call a breaker block. Now, a breaker block is basically a failed order block, or a failed zone. Basically, it's just like when you have your support and your resistance, then price comes to the resistance, and instead of selling from the resistance, price break past the resistance. That resistance level automatically becomes a zone that market will retest to and then continue buying to the upside. So something as an order block. So an order block that market fails to hold from, it was what a breaker block is. So let's say, for example, yeah, this is an order block here, for example. This is an order block, a bearish order block. And normally the scenario is for market to come here and normally sell from the what? A bearish order block. Now, when market buyer, let's say, for example, sometimes when market bias is changing and market is no longer bearish, it means that it simply means that this order block is probably not going to hold. So when market comes to this order block here, and then instead of selling from here, it breaks past this order block, then this other block automatically becomes what you call a breaker block. And then what you expect market to do is what, to retest that breaker block and use it for a buy instead. That is what a breaker block is, an order block that failed to hold. So it's basically simple. So it can also be, and in this case, market does not have to engulf the candle. It can be this, it can be this right here is an order block. So when price comes in, and then instead of buying from here, and price actually like fails to buy from here, do you understand, and breaks this zone, eventually, if market gives you inducement, later price can come to this breaker and then use it for what? A sell instead. I think that's currently what gold is doing now. It is respecting this breaker block for a sell. That's why markets made this retracement to the downside that it just did. Do you understand? So a breaker block is a what? A failed order block. Now there are rules in picking a point of interest that will let you know whether to buy, sell or buy from a breaker, or whether to sell or buy from an order block. Are you guys following me up? Can you hear me properly? Okay, okay. So that's what a breaker block is. So in a situation where markets is doing something this, for example, higher highs, higher lows, here is basically where your order block zone is going to be. So you'd expect market to kind of sell from here. Then when market does not sell from here and breaks past this zone, then this zone that it failed to hold from becomes a breaker. So we basically expect market to come back and retest the breaker and then use it for a buy instead. Once it breaks this zone automatically also becomes a breaker. So you'd expect market to retest the breaker, then use it for what? A buy instead. So any zone that market fails to hold from, there's always going to be any zone that market breaks. Just know that there was a zone that was supposed to push market from that side. Like there was another block that was supposed to push that market to hold the market at that zone. And once market breaks past that zone becomes a breaker block. So this also is what a breaker block. So you expect market to bounce from here to the upside. And also when market sells down and takes this low out, then this low that market just took out automatically becomes what? A breaker block here. Do you understand? So any zone that market takes out, the particular zone the market broke past automatically becomes a breaker block, and you mostly see a shape of an order block there that price failed to hold from. So you expect to use it a retest to that zone as an entry for continuation to the new zone that market started traveling to. So that is basically what a breaker block is. Do you guys understand? Okay, so for every zone where you find an order block, you always find a breaker block there. So in this zone, for example, this particular zone that caused the market to push to the upside is probably where your order block is going to be. Then the zone that market broke past is where your breaker block is going. It is. Then down here also, the one that caused the move to happen, order block, the zone that market broke past, breaker block. And if for this scenario that market sold, this zone that caused the market to sell down, order block, this zone that market just broke, breaker block. So that's just how it is. Order block up here, breaker block down here. This zone that market broke. Order block up here, breaker block down here. So that's just how it is. Order block down here, breaker block up here. The zone that market just took out. So that's just it. So now you can have multiple POIs existing in one particular setup. Do you understand? You can have multiple points of interest existing in one particular setup. But the thing is, knowing the one to pick and knowing the one to make use of, that is where the rules in picking a proper point of interest actually comes in play. So what are the rules in picking a proper point of interest? There are 4 rules that I make use of. Pay attention to this particular topic. Is not is brief, but at the same time it's also very, very, very important. Do you understand? So there are 4 rules in picking a proper point of interest. 4 rules to making sure that the POI you picked is correct and you're not making a mistake. The 4 rules are as follows. So first one of the most important that I pay attention to, the first rule in picking a proper point of interest is what there must be an existence of market structure shifts or a double break structure. So that is the first rule. So it means that before you can start looking for anything, you have to make sure that you see a market structure shifts or you see what a double break of structure. Only when you see that happen, that is when you can now move on to the next part of looking for your POI or whatever. So first of all, let's do for a market structure shift scenario. So if you have a downtrend and market is trending, making lower highs, then lower lows, lower highs, then lower lows, lower highs, then lower lows, lower highs, then lower lows. Everything is pretty normal until market does something like this, takes out the last high. This means that you've gotten what? A market structure shift. Now, what you have to do is once that candle that causes that market structure shift closes, you have to now look below it to find the POI or above it. So now, when market did this market structure, this is where the candle closed and stopped. So it means that I have to look below to find my possible points of interest. So if I look below, I can see what a breaker block here, and I can also see an order block here. So I have what 2 points of interest. It's same as actually as this scenario: lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. The market came here eventually and then made a market structure shift and then closed here. This was what the market structure shift is, and then it's closed here. So as it closed, I have to now look below it to see possible points of interest that's below that candle that closed that market structure. So if I look down here, I can see what there was an order block here that market was supposed to hold, but it failed and market broke past it. So it means that this is what a breaker. Then if you look down here also, you also find what an order block. I think there's also going to be another order block down here too. This also looks like an order block. This also looks like an order block. So this is it. So a breaker, order block, and possibly another order block down here. So you actually have how many POIs? You have what? You have 3 POIs here. Now, once this happens, people get confused. Okay, I have a breaker block here. I have an order block here. Which POI am I actually going to make use of? That is where it gets tricky. I have 3 different POIs here. Which one am I going to not make use of? So first of all, are you guys following me up? Did you hear what I said? I said that the first rule in picking a point of interest, the first rule in picking any entry, first of all, there must be an existence of a market structure shift. Do you get so, or a double breakout structure? So what it means is that if you have an initial downtrend, you don't look for anything PI or whatever until market gives you a market structure shift or a double breakout structure. In this scenario, we have a downtrend, a previous lower high, then lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, then higher high. So it means that we got a market structure shift. So once the candle that causes that structure shift closes, it has to close above this zone or above the high that market just broke. Once it closes, you have to look below it to now find possible POIs. For example, as it closed here, possible points of interest are just this and then this. If it's closed above here, possible points of interest, the ones below where this candle just closed is what is, if you look below, the points of interest is what? Here, then here and here. So you have three. So wherever the candle closes will tell you the PIs they're going to be looking at. For example, in this scenario now that I just illustrated, the market was in an initial downtrend. The market took out what this high, and then that was where your market structure shift was. But this candle closed here. It means that the possible points of interest are what? This one below, this other block here, and then possibly another. This looks like also another block, but basically this and this. These are the PIs you're paying attention to. If this candle actually closed above here, it means that the POIs will be what? This breaker block, this other block, and then this one. So wherever the candle closes, the POIs below, depending on whether it's a downtrend or an uptrend, the POIs below or above are the ones they're going to pay attention to. I hope it's understood now. Hang on, I'm coming. I'll give you a self scenario. Which one is no? I can't explain it any other way again. Maybe probably try watching the recording, but I've explained it twice already. I don't know how else I can explain it. For a sell scenario, okay, the GJ that, okay, sorry, yeah, the gold sell that I took then also has a sell scenario. We have an uptrend here. So we kept an uptrend, higher highs, higher lows, higher highs, higher lows. The whole thing continued until after this last higher low, market made a higher high. Then instead of making another higher low here to push up, it took out this last low. So this is what you call a market structure shift to the downside. Once this candle closed, you have to pay attention to the upside to find possible points of interest. So if you look to this upside, this is an order block that market failed to hold from. So this is what a breaker block. And up here is also what another order block here. So you have two possible points of interest. I don't know if you guys understand what I mean. Once market does a structure shift, whether to the upside or to the downside, and the candle closes, if it's, you just have to pay attention to the points of interest before that candle. As this closed here, you have to now look to the upside, but this is where it closed. So once this candle that caused that structure shift to happen closes, now look to the upside, you'll find points of interest there. So for here is a breaker and an order block. I don't know if you guys are following what I'm saying. If you don't understand, please backtest it later because I'm explaining it as simple as I can explain it. If this is an uptrend, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, lower low. Once it closes here, we look above to see points of interest, and this what? This breaker and then this other block up here. If the structure shifts happen towards to go a bit lower like this, if you look above, the points of interest is what? This breaker, then this breaker, and then this other block. So it's now three. So the more zones get broken, the more your eyes will show. I don't know how else to explain it to you guys. Oh, okay. So now that is the first rule. You make sure that there's what a double structure shift. You make sure that there's what a market structure shift or what a double breakout structure. That is the first rule in picking a point of interest. Now, after that, you now move on to the second rule. So I'm using two scenarios now. This buy scenario that I took here, and also the sell scenario on the other side. So now the first rule, we already gotten it that there must be what an existence of a market structure shift or a double breakout structure. Now the second rule says there must be what? There must be an inducement slash liquidity. So it means that after you've gotten your market structure shift, the second thing you should be looking out for is that pullback that market will make after that structure shift. So after market gives you that your double break of structure or your market structure shift, the next thing you pay attention to is after that candle closes, the pullback that market will make. That is what you're going to be looking for. That's what you're going to pay attention to. So now, so in this scenario, this is what you will now do. If market has given you a structure shift, the next thing is what to ensure that there's an inducement or liquidity. So I'm expecting market to give me a pullback before eventually pushing back up. So that is the second rule. There must be what? An inducement or liquidity. So in this scenario, as we had the previous downtrend and market gave us a market structure shift to the upside, after that, the next thing that market did was to pull back and give us what? An inducement, and then it continued pushing back to the upside. Do you understand? So that is what my second rule, which is the inducement right here. So far, we've gotten the first and we've gotten the second rule. So in this buy scenario, the previous downtrend, market structure shift, that's the first rule. Second rule, there must be what? An inducement or liquidity. Now, the inducement is already marked out here by the first pullback that market, like the pullback that market made before it continued pushing back up. That is what our inducement. Now, same as this zone, this scenario. So as market did this market structure to the upside, to the downside here, it's closed there, and then the pullback that market did was when it pulled back up here. That is it. This is what our inducement. So now, remember, we still have 2 points of interest here. The breaker block here, you can switch time frames if you don't really see it and it's not clear. The breaker block here and the other block up here, do you understand? Then for this zone, we also have what? We also have the breaker block here, and then we also have the other block here. So now, that's where the third rule comes in place. So after the second, are you guys following me up? Okay. So now, after the second rule, you now move to the third rule. This class is brief. This topic is brief, but it's very important. Do you understand? So the third rule says the point of interest you should pick should be unmitigated. So the point of interest needs to be unmitigated. Now, first of all, mitigation means price coming to touch a point of interest after there has been a market structure shift or a break of structure. So what I mean is, if you have, like, for example, let's say this is one point of interest, this is another point of interest, and this is another point of interest, and market all of a sudden does a market structure shift to the upside. If after doing that structure shift and market comes down while creating inducement, it does something like this and then pushes up, it means that this point of interest right here, market has mitigated it because it touched the point of interest. Do you understand? So any point of interest that market touches after the structure shift, if market touches any point of interest, then that point of interest has been mitigated. So it's telling you that any point of interest that you want to pick should be unmitigated, the one that market has not yet touched, especially when it's creating inducement. So if you pay attention, the market was on this downtrend and it gave us the structure shift to the upside. While market was pulling down to create inducement, this particular breaker block here, market touched it. So it means that this breaker block has been mitigated. So automatically we have disqualified this breaker block as an entry. So this is disqualified. You understand? So the POI so yes, you have to follow these rules correctly. Anyone that does not follow any POI that does not match any of these rules, you disqualify them. So the first rule says there must be an existence of a market structure shift or a double break of structure. So we got that when we got the structure shifts here to the upside. Second rule, there must be an inducement or liquidity. The pullback here gave us our inducement. Now, third rule, the point of interest needs to be unmitigated. It means that any point of interest that market touched or went deep inside or touched or whatever, while market was creating inducement, you have to also disqualify that point of interest. You can no longer use that point of interest as an entry. So in this here, we have what? We have an order block here and we have a breaker block here. But while market was creating this inducement, pay attention, market actually touched and mitigated this breaker block here. So what does it mean? It means that this breaker block here has now been what? Disqualified to be used as an entry. Which now leaves only what? It now leaves only what? Only this other block here, and then probably this one down here. I wouldn't really call this another block, but it looks like it's zone. There's also a possible zone. So it now leaves these two zones here. Now, also the same thing as for the cells and for the cell that I had here. So market gave us this structure shift to the downside. We got that as our first rule. Market pulled up here and gave us an inducement and pushed back down. We got that as our second rule. So now the third rule says the point of interest needs to be unmitigated. It means that when market was creating inducement, it needs to not have touched this point of interest. And if you pay attention, when price came here to create your inducement and go back down, it never touched this breaker, and it also did not touch this other block. It still means that no POI here has been disqualified. So two of them are still valid to be used as an entry. Now, but you're still confused. Okay, I have two valid points of interest. Which one am I now going to use? So now the final rule now says you should what? You should pick the point of interest that is closest to your inducement. So that is the final rule. So now it means that eventually, when we have how many points of interest remaining here, we have this breaker block here and we have this other block here. Now between the two of them, where is my inducement? My inducement is right up here. Now between these two POIs, which one is closest to my inducement is what is this breaker block. So that was why my entry would be what? From this breaker block here. Then my stop loss below the candles of the breaker block probably going to be here. And this is where my entry is going to be. So what I expect market to do is to eventually come, sweep that inducement, then trigger my buy from this breaker block here. Simply because it's the one that follows all these four rules completely. So that is what I literally did here for this trade. So after market gave me the structure shift, that's rule one, gave me my inducement, that's rule two. Thirdly, I got the unmitigated points of interest because the one that market mitigated was this breaker, so I disqualified it. So it's not now left with what this other block and this one down here. So I still have two POIs that I can possibly make my choice from. And then the final rule now says pick the point of interest that is closest to inducement. And between this, because the ones that has now left is this and this, the one closest to where my inducement is what this other block. And that was why my entry for a buy was from this other block here. This was the setup. Simple thing. Price, structure shift, inducement, point of interest that follows all those four rules correctly. This was the before. This was when market hits the POI. And this is the trade currently running in profit now. And there was no drawdown, no single one, just hit the POI and started reversing up immediately. So that is how I was able to even catch this buy that gold is currently on for this week. And then for the sell part, same thing, same rule applied. First rule, there must be what? A market structure shift or a break of structure. We got the what? The market structure shift. After that, the next part of the rule says there must be what? An inducement or liquidity. That's inducement slash liquidity. Now this is my inducement. Now the POI is there, is what? This breaker block and then this other block up here. Now, after that, the third rule says the point of interest needs to be what? Unmitigated. It means that when market was creating inducement, it needs to not have touched any point of interest that you're looking at. Anyone that market touched during that inducement process, they need to disqualify it as an entry. So now, since price did not touch this breaker block and did not also touch this other block, two of them are still valid POIs to be used as an entry. But the fourth rule, the final rule now says, pick the point of interest that is closest to where your inducement is. So if you stretch this out, this is my inducement. Now, between this breaker block and this other block, which one is closest to my inducement is this breaker block. So that was why my entry for this trade was from this breaker block here. And then my stop loss is what? Above the last candles of the breaker. This is the two candles that made up the breaker block. So my stop loss was just above them, slightly above them here. So that was, I took this trade all the way down to this zone. The one is to around 1 is to 20 because I did one is 20 on this setup. So it means that if you risked $100 on this trade, you would have made $2,000. If you risked $1,000, you would have made $20,000. This was hang on, trying to see the analysis. Hang on, I'm coming. Aha, and this was it. Structure shift, inducement, breaker block. Exactly the same rule that I gave out here. So once you follow these rules, you understand it's not difficult, but at the same time, most people can make mistakes. Do you understand? Make sure you map out your inducement correctly, switch between time frames to see the one that is more suitable. You understand? If you can check your 30 minutes, 1 hour, the one that is clearer, then pick those four rules correctly, you will hardly, trust me, you will hardly get missed entries. Now, pay attention, since I have those rules correctly, I know that market is not supposed to go and mitigate this other block. So that was why my stop loss did not try to cover this other block, because remember, like I said, there are rules in picking a point of interest. If initially market was supposed to come to this other block, it means that this inducement was supposed to have mitigated this breaker block first and went down. You understand? So if market mitigated this breaker block when it was creating inducement and then went down, it means that my entry would have been from this other block up here. Do you understand? My entry would have been from this other block up here. Now, since market did not mitigate that inducement, did not mitigate this breaker block, there was no point extending my stop loss all the way above here, because if that zone was to be my entry, market would not still come and tap me in for the entry. So why would market now come and tap me in for it being my stop loss? Do you understand the logic? If you follow these rules correctly, you will know that, okay, since the market is actually supposed to reverse from here, if I had kept my entry here, this would have been a missed entry. So with that logic, if I keep my stop loss here, it will also miss my stop loss, because market is not supposed to get to that zone if I follow the four rules correctly for picking a proper point of interest. You guys follow me up? Okay. This also happened for a double breakout structure. Market took out this low while also taking out the previously existing support zone here. So this already is a downtrend, lower highs, lower lows, lower highs, lower lows. So this is a downtrend. The market made a double break of structure here when it took out this low and this existing support level here. So this is what you call a DBOS, a double what break of structure. After that, that is the first rule. The first rule says there must be what? A market structure shift or a double breakout structure. So in this scenario, what we had here was what? A double breakout structure to the downside. It means that we're still bearish, because a breakout structure is a continuation entry. So we are already bearish. Once we got the double breakout structure to the downside, we're still continuing our bearishness. So we look forward. After we've gotten the first rule that says there must be what? There must be a market structure shift or a double breakout structure. Look out for the next part of the strategy. That's the next rule that says what? There must be what? An inducement slash liquidity. Like I said, the inducement is the first pullback after a market structure or a double breakout structure. Now, it means that what I'm looking at is what? Like I said, inducement can be a single candle wick, because the volatility of this market and the time frame of this market did not allow multiple candles here. It was just this one candle that market used as the pullback. So this was what our pullback is. This is the inducement here, which is what the second rule I would IDM, I'll mark it with IDM. So the first rule is there must be a market structure shift or a double breakout structure. So we got the first. The second rule is there must be what? An inducement slash liquidity. So we got the second. The third rule says the point of interest I'm looking to pick needs to be what? Unmitigated. Now pay attention, we have multiple point eyes here. We have what? As this stopped here, we have this breaker, and then another block up here. So we have actually multiple POIs here. But the one to pick actually is what? The one that follows all these rules correctly. So now we have this, and we also have what? This breaker block here. In fact, we also have a breaker block here, but this breaker and this one are actually on the same line here. Basically, they're the same. So now we have what? Three POIs here, possible POIs that we can use. Are you guys following me up? Okay. Okay. So now we've gotten the first rule that says yeah, there must be a market structure shift or a double breakup structure. Second rule that says there must be what? An inducement slash liquidity. The third rule says the point of interest needs to be what? Unmitigated. It means that you need to make sure that any point of interest that you're picking, while market was creating inducement, it did not touch this point of interest. Now, this is where my inducement is. And if you pay attention, there was no point of interest that market mitigated when it was creating the inducement here. This is unmitigated, unmitigated, unmitigated. So you see I have the 3 points of interest. So you're still confused. Which one do I actually pick? Now the final rule says pick the point of interest that is closest to my inducement. So where's my inducement? Right here. So between all these 3 points of interest, which one is closest to where my inducement is this breaker block here. So that's where my entry for this trade will be, from this breaker. And then my stop loss above these are the candles that makes up the breaker block here. This and then this, including this. So I'll keep my stop loss slightly just above here. That's candles of the breaker block here. So that was why when markets came back and saw the inducement, it tapped from this breaker block all the way down here. Still a 1:20 risk to reward ratio trade. Second one, the same thing. First entry, I already showed it. The second entry is this breaker block here. I entered later after like market hit the end, but it's the same thing. So this was the same trade. This was the trade right here. So using these rules in picking the point of interest, I was able to maneuver my way around the charts, knowing where to properly place because now imagine if I had no knowledge of these rules, I would be skeptical because I know that there's a POI here and another one here. So probably my stop loss will be all the way up here. Why? Because I'm still skeptical whether the market can come here and react or it can come here and react. I'm not sure because I don't know those rules. So because of that, this trade now has become what? A 1:7 risk to reward ratio. Even if it risks $1,000, it would have made $7,000. Very, very decent. Do you understand? But compared to having those knowledge and then risking 1,000 and making $20,000, that's $13,000 extra because of knowledge. Same thing as this. If I had no idea, I would have been trying to cover every zone here that market can possibly come to. Do you understand? Because I don't know where market may possibly reverse from. Turn this trade to a 1:3. Even if I'm trying to be decent, let me just say I'm covering this one. 1:4. Risk $1,000, make 4,000. Risk $100, make 400. But because of that knowledge of those rules, knowing that markets, why? Because of I follow these rules, this is where market is really supposed to come to or come to. Because of that, my POI and my stop, this is a 1:20. So risking $100 would have made 2,000. Risking 1,000 would have made 20,000. Risking 10,000 would have made $200,000. Do you understand? Simply by having the knowledge of zones to pick because of these 4 rules here. So this is not something you rush. Do you understand? If you're having difficulty, back test, just have this before you make any analysis. Have this rule next to you while you analyze. You have this rule there and pay attention to it. It helps a lot. It was going to help you a lot if you have this rule mapped out. So once you have any analysis, you have to look. This analysis I'm having now, is there a structure shift here? Is there a double break of structure? Do I have an inducement here? The point of interest I'm looking to pick, the market mitigated or is it unmitigated? Is it the closest one to my inducement? Once you have all these things in check, you will hardly have a missed entry or have market hit your stop loss and still continue going in your direction simply because you were wrong. You guys following me up?